Okay, strategies for 3% monthly profit, around 36% annualized return. This is part one, knowing when to move with the market. But let's address what we're talking about here. Max sent me a question via email on Thursday. Based on your experience, is there a way for an options trader to get a 3% monthly profit on the entire portfolio consistently in any market conditions? Which are the most suitable strategies to reach and maintain this goal? And if not, which is the highest monthly or yearly profit reachable consistently along the years and by using which strategy? Let's go back 1 month. On August 6th, we got a question that came in was, what is your best or favorite strategy to use? And during that presentation, we launched 2 polls. This question also involved what's the average quarterly return of that favorite strategy. The first question, we polled the audience after some discussion. You can look that up later on YouTube if you want. But of our attendees, historically, what has been your best strategy? 46% said covered calls and naked puts. 31% credit spreads, debit spreads, maybe condors and butterflies. 8% said buying calls or puts. We also included straddles or strangles, buying straddles or buying strangles. And then diagonal spreads or poor man covered calls was 15%. Was their best strategy or historical strategy. Mine was credit spreads in the right market. Many of you know that from the 2019 to 2019 years doing the bull put credits, really 2016 through 2020. Ups and downs, but overall hitting the exact targets I wanted. Now, we couldn't put all the strategies in there, but we asked again later, just after that, not consistently, but what was your best annual return? We had 15% say greater than 50%, a little bit more than 4.2, 4.4% per month. 8% said 40 to 50% per month, which is 3.75% roughly. 30 to 40%, around 3% per month, was 8% of the audience. Around 2% per month, 20 to 30% annualized return was 15% of the audience. And as you can see, the bulk of the audience was in 10 to 20%, around 1.5% per month. So really close to 70% are in this 10 to 30% range, 1 to 2% per month, maybe a little bit more, as the best annual return. Now, I know what's out there. I get the emails too. Part of my job description is to know what the competition's doing. I get the emails of, oh, buy calls and puts, and we got double or triple our money in our last 8 trades. Look at the money debit spreads, low risk, 1-to-1 risk reward ratio, 50 to 100% profits on your investment. Poor man's covered calls, get 70% off the price of the stock and really leverage your winnings. So if there's so many great strategies out there, why are so many, every time we take this poll, 60, 70%, staying with covered calls, naked puts, and collars? Is everyone settling for just a 1 to 2% return per month? I wouldn't call that settling, I call that winning. And because, in my opinion, that is a more realistic expectation of return. It's around 1 to 2% per month across an entire portfolio using options. That may be 50 to 60% in married puts, collars, or covered calls, or naked puts, for example, with maybe 10% in spreads, maybe 10% in calendar spreads as well. And, maybe leaving 15% in cash and playing 1%, 2% with a market hedge, and so on. You've heard me sort of talk about these numbers before. Now, with the married puts, I look for 1 to 1.5%, either realized or unrealized return per month. In stronger years, such as 2017 or 2019, I was looking for 1.5 to 2% and got it most of the time. But really, that's our expectation with the married puts. And also in the money monthly covered calls. And out of the money monthly naked puts with strong protection, maybe 10%, 8% out of the money for a monthly along those lines. Now, with the bull puts, I've averaged around 15% returns for 14-day trades. But I've also seen that whole portfolio drop down as much as 50% or maybe a little bit more due to an unknown, unexpected event. And the same thing can happen on bear calls as well. A lot of educators have gotten in trouble claiming you can make 3 to 6% per month with covered calls consistently. Some have even gone to jail over their false claims of what returns to expect with options trading, different strategies, and so forth. wasn't for one of those gentlemen, Kurt probably never would have written the blueprint and developed the married put technique. He took that course years and years ago and almost lost about 75% of what he had decided to trading by following the advice. But let's do what we did before we go further into this little discussion we have from Max. What is your go-to strategy? What makes up the bulk of your portfolio? Is it covered calls and naked puts? Is it protected positions, married puts and collars? I think you can only answer one. That's why I mentioned the bulk of the portfolio. Is the bulk of your portfolio in credit spreads, debit spreads, will include condors or butterflies in those positions? Is it buying options, buying calls, buying puts, doing straddles or strangles? Or is the bulk of your portfolio in diagonal calendar spreads, maybe buying an in-the-money call on a higher price stock that you don't have the capital, but you're still going to sell calls against it? The poor man's covered call, for example. And Jim, I do see your hand is raised. Yes, we're going to get to your question right after we wrap this up as well, related to the calendar spreads, the horizontal spreads. I'm going to leave the poll open for another 10 or 15 seconds. About 15% of the audience has voted. I'm sorry, I read that wrong. About 75% have voted already, excuse me. So we're just going to leave this open for a few moments. All right. Now this is different than the other poll because I had an extra thing in there, and I'm not surprised to see this, but I'm happy to see this. Anyway. Oh, whoops, I'm sorry, something bad just happened. My apologies. There we go. Sorry, folks. Oh, no, some answers are coming in now. We still got a couple more that just voted. Very good, very good. All right, let's go ahead and close the poll and move on, though. This one is less than I expected. Only 15% are doing covered calls and naked puts. 38% are doing the married puts and collars. Well, it is a Power Options webinar, and many attendees here are probably blueprint owners, so I understand that. 23% credit spreads, debit spreads, condors, and butterflies make up the bulk of their portfolio. 23% buying options, calls, puts, straddles, and strangles. Very good, very good. All right, so let's go. No one said calendar spreads, and that's okay. Let's go ahead and hide the results, and let's do our follow-up. Think about this together. What is your target, expected, and usually realized return? Is it 1 to 2% per month, about 10 to 24% per year? Is it 2 to 3% per month, about 25 to 36% per year? 4 to 6% per month, that'd give you 45 to 70% per year, roughly. 6% would be 72% per year. More than 6% per month, or are you averaging around 8 to 10% per year, which 10% is still good long term. We're in this for the long haul, all of us, but under 1% per month, talking 8 to 10% per year. All right, so we've got 58% voted. Poll's been open for almost about a minute. We're going to leave it open for a little bit longer here. Another 10 seconds or so. All right, it's not changing too much, but some more votes did come in. All right, let's go ahead and close that. Let me share it with everybody. As expected, sort of, from the last poll we saw as well, 46%. Target expected realized is 1 to 2% per month, around 10 to 24% per year. 23%, 2 to 3% per month, at 25 to 36% per year, around what Max is looking for. He's more in the 3% to 4% he's hoping for. 15%, 4 to 6% per month, 45 to 70% per year. That's fantastic. 8%, more than 6% per month, closer to a 75, 80, maybe 90% annualized return, and 8% are under 1% per month. So the main target here, again, about 70%, is 1 to 3% per month, target, expected, and realized returns. That is just what we expect and what we normally see, Max, when we run these polls. Is everyone settling for a 1 to 2% return per month, 10 to 24% per year? No, I'd say they're winning. But that, to me, and to Ernie, if he was doing this presentation, is the realistic expectation. Some years we'll see higher in that 2 to 3% per month range, 25 to 36%, but I would not say it's consistent over time. There's ups and downs. Yeah, sometimes I've had great years and great months of trading. Sometimes not so much. And I think, let me share that result again real quick. I think at one time or another in all of our trading, I hope so, but I think at one time or another in all of our trading that we've done, everyone in attendance here and myself and Ernie included, we've been in one of these categories at one point or another. Not that we've expected it, but we've seen 4 to 6% per month. We've seen maybe more than 6% per month. We've been under 1% per month. We've lost, and over the time. We've had losing years. I've had losing years. Not big ones, down 1 or 2%, but that was in 2008, 2009 when everything was crashing. A lot of married puts in my portfolio at that time. All right. So let's move forward. And now that we've got that in our back pocket, is that even possible is the main question. 2022 has been rough for us all. Now, you've heard us from the beginning, from January, discuss new strategies, new ideas that we weren't trading before. We've talked about, hey, I'm going to play around with these out-of-the-money strangles on SPY, which have turned out really well. We are talking about bear puts spreads, which we normally didn't discuss in the beginning of January through February, and then again in the May downturn. But we always keep the stalwarts in our portfolio. So, those that they're doing covered calls, they still have positions where they might be using deeper in the money covered calls for a hedge. They might be using collars. We're using the married puts. That's 40 to 50% for me. It's higher for Ernie, 70 to 80%. But inside the covered call structure, the out of the money naked put structure, which is very popular, of course, and even the married puts, the adjustments, the rolls, the income methods we use against the married put are going to be dictated to us by what is happening in the market. And the smaller portions of our portfolio that we're playing on the side, our structure, our timing, that is going to be sort of ruled by the market conditions at the time as well. So, where are we going here? Let me go back one, I'm sorry. Of course, we can just look at a chart and we can say overall we've been bearish. Started off at about 480, right? And, closed today at around 400. I didn't even see the close. I was working on some other stuff here. But yeah, right around 400. When I took this screenshot, I think it was this morning. So we can say, yeah, we're down 80 points. It's overall been bearish on the market as a whole. And it's 17%, roughly 16.6% that we're down currently in the market. Okay, so it's been bearish overall. Does that mean that starting in 2022, that bear call credits, bear put debits, and calendar puts were the go-tos for the entire year? This is based on Max's question on what strategies can consistently generate 2 to 3% per month. And the answer is not all the time. Even with the market being as low as it was near the end of July 25th, we ran our back testing tool looking for the 2-week out bear call credit spreads with the 85% probability on stocks in a downturn. The success rate was 82%. That's in the wheelhouse of what we want. We want to be 84 to 87% successful, but 82 is in the wheelhouse. We're hitting the target return that we want for a credit spread. 15% on the winners on average with the 85% probability, and keeping the losses controlled. We'd like to see that under 50%, but there are a lot of gaps that got away from us even on the bear call side. But just through July 25th, you can see that this portfolio is down 16%. If we started with $10,000 and allocated $3,300 to the top 3 trades, and yes, we were using a stop as well, standard, 1% rule in a sense to stop the things at 50% maximum loss, 50% of the total, we're down 16%. It's down to 84.03. Now, bull puts fared much worse because it is a bearish market. But that didn't mean that bear call credit spreads, just placing them, you'd be successful. The bull puts were terrible. 62% success rate. Can't win in credit spreads, even if you're controlling your losses to 35 or 40%. You need 75, 80, 85% to be successful. We usually hit that. Because of increased volatility, the average return for the winners, 11 of them, 29 wins. 29 wins and 18 losses and 47 trades. So 29 wins at 17.8%. But we're down 87.4%. But that's kind of what we expected. Oh, I'm sorry. Sorry, folks. That's kind of what we expected, even with the 85 to 90% probabilities, because you can't just do one strategy and go through all market conditions and say, this is going to work. I could be at 95% probability. I'd still be at losses with bull puts. I could be at 95% probability with the bear calls, and I might still be underwater because of the shifts. This I'm using to illustrate key points. Number one, it's risky, in my opinion, and hey, some of those people that answered the poll that said credit spreads made up the bulk of their portfolio and buying options, the lie of leverage does destroy those strategies. Buying calls, buying puts, doing credit or debit spreads, one unexpected event, your portfolio can quickly be down 50, 60, even 70%. That portion of your portfolio, remember, those positions can lose 100% of you invest. No one's doing that. No one's just putting on a trade and saying, I'm just fire and forget. It's going to win X amount of times and I'll just take the losses and I'll be successful. Management in any strategy is key. Okay, there's no fire and forget one strategy for all market conditions. You have to move with the market and adjust strategy if necessary. Both bear calls and both bull puts would have lost so far in 2022. We just saw that. But what if we did bear spreads just from January 5th to March 14th? And then we did bull put spreads from March 30th to... I'm sorry, I read that wrong. From March 14th to March 30th. And then March 30th to May 10th, we're in bear spreads. And then we're in bull spreads from May 10th to August 15th. And then from August 15th on, we're in the bear spreads. Now, it's easy to look at a chart and say, okay, yeah, I see what you're doing. But let's take a look. What would have happened in this case had we done that? Had we switched with the market and moved forward? First, January 2nd through March 11th. Take that $10,000 that we showed that we used in just the bear calls and just the bull puts. Same stop. Same criteria, 85% probability, 2 weeks out in time, opening positions on Monday and taking the top 3 trades. In that roughly 2-month period, the $10,000 went up to $24,321. Yes, this is a back test. It's not real market conditions, but the stops were in place. There were 15 wins and no losses for 100%, and the average wins were 20.5% because volatility was increasing and the VIX was high. We were getting extra premiums even at the 85% range out in time. Now, we switch. After March 11th, on March 14th, for only about 14, 15 days, just one cycle of trades, we move into the bull put credit spreads, continuing with the funds that we had after our bear run number 1. We start off with 24,321. We only open 3 trades. We have a 100% success rate, 19% average return, and the new cash on hand in that portion of our portfolio is up to 28,867. Then we switch again. March 30th, we change back to bears. Bear run number 2, March 30th to May 10th. Roughly about 1 month, so we've got 2 to 3 cycles in there. We open up 9 trades during that time period, and we take the 28,867 up to 41,655. Again, no losses, 9 wins. Average return is 18.3% because at this time, volatility, the VIX, is still relatively high, and we're able to get the higher premium. Now, we switch again. Bull run number 2, starting roughly at around, let me clear out the drawings, I'm sorry, May 11th or so. Did I start on May 10th or I started May 11th? I've started on May 8th, so kind of close. We're closing out the bear calls and we're seeing to open these on May 8th, and we get hit, okay? We take the 41,665 that we've built up with 2 bear runs and 1 bull run, and it drops down to 33,767. Got a 19% loss. We take 6 losses and 18 wins. We only have a 75% success rate. We're still getting above average return. We're usually expecting an average of around 15% return with these 85% probability spreads 2 weeks out in time. And the losses go a little bit beyond our usual goal, of 50%. We're 56.4% on those 6 losses that we took. And that brought the portfolio down. That's not as low as it went. There was a giant hiccup in that middle of bull run number 2. We'll show that in a moment. But on 6/13, what ended up happening is the account value was down to $20,965. We lost 49.7%. Let's just call it 50% of what we started out with just on May 8th. Again, this will happen over time in any credit spread portfolio, bull or bear. Usually happens more to the bulls, but the bears get caught at times too. That's why the iron condors are so difficult at time to time, because any unknown event, you're still taking the same similar 40-45% loss due to the unexpected event. We know it happens. I was prepared for it to happen. And as we go back before, let's just talk a little bit quickly about that hiccup before we come back to this. Where are we now? We're in this giant bull spread range, but we're in this ouch section right here. This is what happened. We started on May 8th and we were swimming along, and then now we're down to 20,000, starting off with 41,600 after just a month. And we made it back up to 33,000, 37,000, whatever it was. June 9th and June 10th, what happened here, remember? That's when the final inflation numbers came out. And we found out that May inflation did not decline. It actually increased to 8.6% from 8.3%. And then on June 19th, we start to see things turn around a little bit. That was the surprise 0.75 rate hike that came out on June 14th or 16th. I forget which one it really was. Some sites said the 16th, some said the 14th. So in any case, that's where we are, and that's where we got hurt. And that's what can happen. But remember, if I had just done bull put credit spreads all the way through the year, by July 25th, after that event, we were down to $1,200. If we had done bear calls only, we were down to $8,600. We took a hit, but by following the market, we're still at $33,767. Right? So we continue on. We end this on 8/14. On 8/15, 14 days ago, a little bit more than that. I'm sorry, 16, 17 days ago. We go into bear run number 3, back to bear call credits. We get up 19%. We're back to almost where we were. We're back to 40,358. We had 2 cycles of the 2-week out spreads from 8/14 to 9/2 roughly. So we had 6 total trades, 100%. The average return on the wins was pretty low, though. It was only 9.5%, which is a little bit interesting. But yeah, we kept the funds in place, rolling through, and we switched from bull to bear and bear to bull as necessary. We moved with the markets. Now, who wants to say it first, of course? Great, Captain Hindsight. Anyone can look at the past chart and tell you what they could have done, tell you when it was the exact time to switch from bullish spreads to bearish spreads, to switch from buying calls to buying puts, to doing married puts on long stocks to doing married puts on inverse ETFs. True. But those dates aren't based on me looking at the chart. Those dates were based on what I did with the SPY strangles that we've mentioned before in the portfolio because of the signals in the market sentiment tool. At the beginning of the year, we started to see sell warnings on around 12/27. So that first bear run that we mentioned, that was because the market was showing us what it was doing. This remembers when we were talking about bear put debit spreads, calendar put spreads. You can go back to our YouTube channel, look at what we were talking about on January 10th, January 15th. A lot of discussion on managing covered calls, rolling down naked puts, absolutely. But we were introducing concepts of some of the bearish plays. Why did we go into bullish spreads on 3/14? Because that's when the first bullish buys started to come up. They started around 3/9, but the real bullish buys started to appear on 3/14. We moved into the bull spreads. Why did we switch in 15 days? Because that's when we started to see the strong bearish sell warnings. Usually when I see 1 or 2 of those in a 2 or 3 day time period, I'm going to switch and go back to bearish structures, start hedging my existing positions, my married puts. I'm going to start selling calls, maybe add an additional put. I'm going to lighten up on my calendar call spreads. That's what we do. And we rode that from 3/29 to May 10th, May 11th. Why? That's when we started to see the very bullish buys right here. That's when they started to trigger. And it started to work right, but this was the unexpected. We didn't switch at that time because 8 days later, around 6/15 and 6/16, we saw the same thing. I didn't include it here in the screenshot, but the market sentiment tool went back to very bullish buys in this range right here. Our original signal was here, and it was going good. And then this started to scream very bullish buy again. So we stayed in. We took the hit, but we stayed in. August 15th, August 12th, this was the last roll I did actually on my SPY out of the money strangle. I moved it, took the profits on it, and moved it back to a 0.3 delta to October for the call and the put. But yeah, we would have switched back to the bearish, and that got us back to 40,000. Am I looking at the chart and picking the dates? No, I'm following the dates in the market sentiment tool. That's what we've been doing. There were some other light buys that came in, I think, before this in February. Yeah, it was in February around this time, if I'm not mistaken. I didn't do that then. I stayed because they were just light buys. It wasn't a full bullish buy or very bullish buy yet. It didn't quite go that deep. And right now, here's where we are after today. We saw a bullish buy come up, so this might be the end, and I might be switching again if I'm doing this in my portfolio. I might roll now my SPY out of the money strangle, close my October options. I might stay in October actually, but go back to where is now the 0.3 delta call and put for October and continue with this rolling the strangle idea based on what the market sentiment is showing me. So I didn't cherry pick the chart. I cherry picked the market sentiment tool, which I've been using for my trading to help manage existing positions, roll some of those strangle positions, protect the married puts, and other things along those lines. That's what we're looking at. That's why we selected those dates based on the Power Options market sentiment tool. But let's talk about this. Going into max, what is that return? We started with $10,000. The ending amount was $40,358. So, wow, we have a profit of 303, let's call it 304% for about 8 months of trading. But remember, the credit spreads for me personally only would have represented 10 to 15% of the account. Why? Because at one time or another, bull or bear, I'm expecting to see a 48, 49, 50% decrease. I had the market direction correct, but the numbers were a surprise that inflation still increased. The market panicked. Then there was other news about what was going to happen, and the market sold off, and that happened. Same thing happened to me in 2018. Rolling along with the bull put credit spreads, it was February 5th, February 9th, 2018. The market had a drastic fall in those 3 days, and it was right before an expiration. I think February 9th was the expiration. I had 3 positions going into. By the end of the day, February 5th, all 3 of those positions were closed. That I had the bull puts open for an average of a 48.9 or 49.8% loss. Portfolio was down 50% from where it was just the day before. And that was all because the president at the time said he decided it was a good time to start a trade war with China, and the market did not like that idea at all. Whether it was a good idea or bad idea, the market hated the idea, and it was a 3 to 4 day drop, and it wiped out the bull puts. In any case, this would have been on a $100,000 account. If this was only 10%, this $10,000, it still would have been a 30.6% profit in 8 months, or about 3.8% per month, sort of hitting what Max is looking for. But it's not one strategy. You had to shift with the markets. You'd have to do the same with debit spreads. The straddles and the strangles are an idea that you can do in various markets. But various markets like we've seen in 2022, buying a straddle, buying a strangle, trying to profit on both sides. However, if we get into a melt-up market like we had in the beginning of 2021, those were not profitable. They were going to losses. There wasn't enough movement to see the gains on one side or the other, or to manage it really effectively. This market has had that, but it's also been expensive to do those because of the increased implied volatility. So we just wanted, I know it's been about half an hour, but we just wanted to cover this first. The question that Masks asked, is it possible to get 3% per month? We saw some of our audience was able to get that and is expecting that 2 to 3% per month. And some are expecting more than that, 4 to 15%, but it's only 23% in the 2 to 3% per month, 46%, 1.2% per month. That's the realistic target. But I didn't go through a lot because I don't want to spend the full hour talking about this. In part 2, later on, next week sometime, we'll discuss what about the other 80% of the portfolio, what strategies and structures should be used, what structures should you avoid in this type of market with a focus on proper expectations, proper position sizing, and more. Despite what we just showed, we are not directly recommending trading credit spreads in this market. Unless you know what you're doing, you're able to be agile, you're able to be nimble, and you're able to switch positions. This was an illustration to show the importance, part one, of how you need to follow the market and be agile, to emphasize that no one strategy can be expected to profit in all market conditions. Backtest results, of course, are not future guarantee in any way of future performance. Options involve risk, as we saw, and may not be suitable for all investors. So we'll, of course, post this, and we'll let you know when part two is ready. I'm going to have to do so. I only had time today to do part one. The reason I only had time to do part one today, Max, other than I didn't want to spend the whole hour talking about it for the webinar, I wanted to split it up to other questions that came in, is there was a lot of back testing involved. And I did do back tests on things we're going to show in the next presentation too. Out of the money naked puts and in the money covered calls, for example, as we saw, a good bulk of our audience still uses in their portfolio, even though they're neutral to bullish strategies, and we've been essentially in a bearish market. But there are ways to adapt. There are ways to change structure in those strategies as well. And of course, keep in mind, what is some of the importance that we have here of, say, doing a covered call? Obviously, you know the importance of doing a married put. It's already protected, so is a collar. But some of the importance of having the bulk of your portfolio in a covered call or naked put position, cash secured put position, is that if a market has a sudden surprise, which we just saw back in June 9th and 10th, and your stock falls 8%, well, you still sold a call against it, and you're probably only down 3 or 4%. That's easy to make up. If I'm in a bull put credit spread in the market, or my stock falls 8%, I'm at a 40 to 50% loss. If I bought a call, I'm probably at a 35 to 40% loss. It's much harder to get back to break even. It's much harder to manage leverage and the lie of leverage. They both work for you and work against you. And that's why I emphasize also the proper position sizing. We mentioned those cases of only 10% or so.